The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today is my Chanticleer colleague. He's less obedient than Barnaby Joyce's dog. It's Anthony Macdonald. How are you, Anthony?
I am sitting down, Barnaby. I promise.
Love it. Well, this week we say farewell to one of the leading lights of corporate Australia. We ask why good news on the jobs front may ultimately be bad news for the economy. And we explain why China just sent a shot across the bows of America's tech giants. But first, Anthony, let's start with the second biggest news in banking this week, and Australia's got a new bank, and it's a biggie. Revolut, the London-headquartered digital bank, which claims 75 million global customers and a valuation of $165 billion as of this week, has won an Australian banking licence. Now, Anthony, most people probably haven't heard of Revolut, but I'm sure it's making some waves in the world of Australian banking. Will the big banks be worried?
Yeah, James, it's one of those ones we've heard plenty about. You know, whenever you're chewing the fat with a bank boss, Revolut's name comes up. And the company's been operating here for a while. Apparently, it's got 1 million customers in Australia who use Revolut for payments and these like multi-currency cards when you travel. And I mean, it hasn't had a banking license here, so it's not really been able to take deposits. It'll now be able to pay interest on savings, which is important. And customers will be covered by the government's deposit guarantee. It's been extremely successful in a bunch of markets offshore, and customers tend to use it as a bit of a second or a third bank account. Maybe we'll see more of that here, James. But the banks have been really good at seeing off these neobank challenges over the years.
Totally.
You know, 10 years ago, it was all the talk and there was a few sort of setting up then. They haven't really taken off here. I mean, Revolut is a big global one. I mean, you think that if you're going to be creating your own products and everything, doing it globally, having a system globally would be the way to do it. Obviously, like you said, it's got a massive valuation, seems pretty well funded. So if anyone could crack it, perhaps it's going to be a Revolut. The big challenger here in Australia is Macquarie, which obviously we're going to talk a lot about today. What do you think about Revolut?
I'm all for more competition. I think Australians are actually reasonable adopters of new banking products. You know, you think about ING, they've had a good little run. I know that there's a travel card/digital wallet called Wise, which has done okay down here. So there are examples of where an offshore digital offering can come in and make some good ground. Bendigo Bank's had okay success with a product called Up. So I think if Revolut can come in and wants to make a bit of a splash with a spicy offering, you know, a very good interest rate, for example, some sort of good digital product, there's a chance that they can, you know, make a little bit of headway. But I agree with you. I mean, the big banks are good at seeing off these challenges. They've picked up their game in terms of digital experiences themselves. So it probably comes down to the interest rate that's on offer. I mean, that's really, at the end of the day, Anthony, that's what's driven Macquarie's success here, isn't it? It's a good offer with a good interest rate. That's what matters most.
Just give the customer what they want.
Yeah, well, let's see how they go. We often bemoan a low productivity economy in Australia. Competition creates productivity boosts, so bring it on, I reckon.
Now, James, I heard you on a great episode of our sister podcast, which is called The Fin, talking about the government's new stance on AI. But I wanted to ask you about this week's big tech story, and that's the emergence from nowhere of a new challenger for the likes of OpenAI and Anthropic. What on earth is this Kimi K3, and should we be worried?
Well, I think we should be worried, Anthony, if our names are Sam Altman and Dario Amodei, the CEOs respectively of OpenAI and Anthropic, because this Kimi K3 model made by a Chinese company called Moonshot AI, it appears to have basically caught up to the best models, or perhaps just below the best models that OpenAI and Anthropic could put out. I think the US AI establishment thought they had a 12-month lead over the Chinese AI establishment. A big reason for that is that because US has banned the export of NVIDIA chips to China. But what this arrival of Kimi K3 says is that the lead that America's got over China in the AI race, it's probably more like 3 or 4 months, and the gap is closing. I was startled when you dig into this. The big Chinese model that we heard a lot about, about 18 months ago was DeepSeek. Remember the DeepSeek scare? It came and sort of went and the tech boom rolled on markets. But actually, Chinese models have done a pretty good job of capturing market share. In America, about 30% of AI usage is Chinese models because they're cheap. We often talk on the podcast about cheap Chinese cars. Basically, China is flooding the world with cheap, particularly electric vehicles, and smashing the global car industry. Are they going to do the same with AI? Are we going to be flooded with cheap Chinese AI? Now, maybe, but that has all sorts of follow-up questions that are really interesting too. The big one is, will governments in the West, in Australia and the US, say, sorry, big Australian bank or big US bank, we're not sure we want you sharing all your intellectual property with a Chinese-made AI model, given that China's record on intellectual property rights is less than perfect. And, given that we're in this sort of strategic competition with China. So there's all sorts of really delicious ramifications from this, but I think it goes back to the sort of grand contest that's going on in the world between China and the US. China's taken a different approach to this. They're not throwing endless amounts of money at AI. They're doing it in a sort of stealth, very efficient way. But their objective here is I think it's to flood the world with cheap Chinese AI, as I said. So that could change a lot of things. And again, Anthony, puts Australia in a pretty tough place as usual, stuck between China and the US.
You're right, James. These things often do come down to cost, though. And, I know there's security concerns much more with AI than there might be with cars, for instance, because it's much more data heavy. But, it's often hard to get past the lowest cost provider.
Totally.
There's often a way, some way or other, despite the regulation, to use it. So, this one's really fascinating, James. And even if the OpenAIs, Anthropics and that can keep China at bay, that's not going to be in all markets. And if their products aren't rolled out as widely as they're expecting now, what does that mean for the prices they'll be charging, for the revenue they'll generate, for the valuations they're attracting now and in the future? What does that mean for their build-out in the next few years if they're not going to be as widely adopted as what they first thought? And as you said, it poses a lot of questions.
Yeah, and you think about OpenAI, they've agreed to spend over the next few years something like $800 billion US about that. You look at the books of Microsoft, Amazon, Alphabet, Oracle, there's about $750 billion US in revenue promises that OpenAI's made to these companies. Like, if OpenAI was to sort of be wiped out by Chinese competition, do we see that OpenAI, as the linchpin of the AI ecosystem, suddenly start to bend or even break? There's fascinating potential for the sort of rules of the AI game to be rewritten. So let's see where it goes, I guess. Okay, Anthony, let's move to our first topic. And corporate Australia received a bit of a jolt on Thursday when one of the real stars of the business community took her leave. Yes, Shamara Wickramanayake is going to retire after 40 years with Macquarie Group and 8 years as its CEO. Anthony, we can measure Shamara's legacy in a few different ways, but, well, this is a business podcast, and perhaps we should start with the crass measurement. Under Shamara's stewardship, the market value of Macquarie has risen $48 billion to $97 billion. What does that say about her tenure?
I think it says she kept the Macquarie machine rolling. A lot has happened in the past 8 years: pandemic, wars, tariffs, oil shocks, all that sort of stuff. She's kept the ship sailing. That's good. Your headline number there sounds fantastic, double the market value of the bank, and there's plenty of goodwill for Shamara out there. Like, she's this quite unique mix of energy, positivity, intellect, and when you meet her, there's sort of warmth there as well and connection. And I think that's the surprising bit with her. Like, she's not a robot. She does have this sort of personal manner that makes people feel good when they meet her. But if you just step back and look at the numbers, she took over on November 30, 2018, and Macquarie's market cap has doubled since. Earnings per share is about double what it was. That explains most of the share price growth. I bet Macquarie's also raised equity. It's got 10% more shares on issue, so that's kind of helps pump up the value as well.
Yep.
But the biggest mover in terms of earnings in the business is the commodities business in there at Macquarie, which is unique for a bank globally. Macquarie stepped into this when others like JP Morgan were stepping out. The other unexpected rise under her tenure has been this Australian banking business, which we mentioned before. I mean, deposits and mortgages built up from scratch to contribute more than $1.5 billion of profit into the group. I mean, that's great. All that says she's kept the ship sailing. She's managed to sort of change Macquarie as it needed to for the times. But what I think your headline analysis of just doubling the market cap, what it misses though, is that this has also been a fantastic time to be the CEO of a public company from a valuation perspective.
True.
Asset prices are through the roof. Like Jamie Dimon, runs JP Morgan, said this week he wouldn't be buying stocks or treasuries. They're just too expensive. You know, markets are really at all-time high on the equity side. Credit spreads near all-time high on the debt side. And if you look at Macquarie's peers, I mean, the ones that it compares itself to in the annual report, JP Morgan, Goldman Sachs, Morgan Stanley, Barclays, Deutsche Bank, for example, its returns are actually underwhelming for shareholders. I mean, those 5 banks I just reeled off, if you include dividends, have returned up to 570% during Shemara's tenure for investors. I mean, the worst of them is JP Morgan, up 290%. Macquarie in that time has returned 204%. Right. So I'm not sneezing at Macquarie's 204%, but I think we need to put its performance in context. And in Australia, I wouldn't say it's underperformed from an ASX perspective or an Australian business perspective, but globally compared to its peers, it has. And why is that? Well, Macquarie, I mean, it kept pace with its peers up until about the start of 2024, but really started underperforming at the start of 2025. And what happened at the start of 2025, James?
What's that?
Donald Trump.
Yes.
Right? And what he's done, he's significantly scaled back capital requirements, freeing up billions of dollars in lending capacity for the big US banks, which is a game changer for them, right? He's turbocharged the economy over there, run it hot, seems to be happy to live with a bit of inflation if it means economic growth.
Yeah.
I mean, he's rolled back the sort of green investment agenda. Macquarie, that was one of their sort of
mainstays,
heartland plays. So if you compare what's happened in the US, though, to what happens in Australia, like what's the Australian government done since the start of 2025 that would help Macquarie?
Yeah.
The answer's not much. It's gone after growth capital, unhelpful. Negative gearing, unhelpful. In the paper today, Albanese's backing a new Fair Work court, unhelpful. Federal and state governments keep spending that keeps interest rates higher, unhelpful. There's a 2% speed limit on the economy, very unhelpful. You know, so what I guess I'm trying to say is we sit here and if you read the papers today, there's lots of pats on the back for Shemara for keeping Macquarie intact and, you know, big shoes to fill type stories. And I'd say, yes, well done. She's kept the ship sailing. But, you know, Macquarie's not perfect. It's had some shockers on the regulatory side under her watch. I mean, its financial risk seems great. The non-financial stuff needs work. I mean, there's enough evidence to say that. But I just can't escape this opportunity to say, wake up, Australia. We have everything going for us, but we're wasting it. And, you know, perhaps Macquarie shows that. But anyway, I know we're here to talk about Shemara. We should get back to that. I mean, she was Macquarie's first female CEO, became a passionate advocate for women in leadership. How much do you think that's part of her legacy?
Oh, a huge part. You know, she's been a real star because she's taken a leadership position on that. She's made some great speeches and given some great, you know, interviews about the importance of female leadership. Now, I found an interesting quote from her from a few years ago saying she stopped seeing herself as a, quote, female CEO with brown skin a long time ago. But I think the trail that she's blazed for women and for people of colour in corporate Australia, that is important. That is a legacy. She's done a lot of stuff with girls' education as well, you know, trying to get more women into financial services and particularly investment banking. So, you know, you hope Macquarie, and I'm sure they will, they'll grab onto those programs and, you know, use the example and the legacy that Shemara's left to sort of carry that work forward. I think it's, you know, really important. We should talk about her replacement, though, Anthony. He's a guy called Greg Ward, who runs Macquarie's Banking and Financial Services division, which we've mentioned. Now, as we've said, this has been the great disruptor in Australian banking. There's an argument, I guess, that we all get a better deal in banking because Ward's built this division from nothing to become a serious player that the big banks are forced to respond to. So Ward has been at Macquarie for 30 years. He's a lifer as well, part of the old guard, I guess. Is he the right choice to fill Shemara's big shoes?
They're very much part of the old guard, James. And like Macquarie's unique. You go in there, and most executives, within 10 minutes, it emerges they started there early in their career, often as grads. They'll say they used to sit outside Nicholas Moore's office or were involved in Alan Moss's strategy team or whatever. You know, the culture, the fabric of the place. It's sort of what makes Macquarie, that mix of entrepreneurialism, you know, backing ideas from the factory floor, as they like to think of it, with this financial risk framework over the top. I mean, that's the Macquarie magic. Yeah. They've got this sort of breed your own, keep it in-house, keep them coming through, you know, like talent factory approach. And Ward's right out of central casting in that respect, nearly 30 years there. He's been on the executive committee, the ExCo, you know, which is a big, big deal inside Macquarie, since 2005.
Wow.
Like that's a lifetime ago. Yeah. That's the year Mackay Diva won her third Melbourne Cup. James, you might remember.
I was there.
Hurricane Katrina in New Orleans. The year that Pope John Paul II passed away. We're into our third Pope since then. I mean, Barnaby Joyce, a Catholic, he was only just entering the Senate.
Did he have a dog back then, Anthony?
I'm sure he had a few. So, yeah, like Greg Ward's been on that ExCo for a long time, CFO in the GFC. Like, imagine how stressful that was. Yeah. You know, remember that hedge funds were shorting the pants off Macquarie, and Macquarie had to get relief or lobbied the government to have a temporary ban on short selling to help get through it. Anyway, he went from CFO. He made what looked like a strange step sideways to run Macquarie's retail business here in Australia. And by retail, I don't mean shopping. Retail, I mean servicing sort of household customers, which at the time, it had compliance and regulatory issues up to its neck. It had an enforceable undertaking over it. And anyway, he cleaned that up. But what emerged from that business was this Australian retail bank. No one saw coming. No one saw how successful this would be. Like Macquarie had sort of mucked around with funding home loans via securitisation before, had this big cash management trust, which was kind of like a deposits business, but it basically built the bank from the ground up. And it's been wildly successful, the biggest disruptive force in Australian banking this century. So overseeing that for Greg Ward, I mean, that's helped get him where he is on November 7, when there's a changing of the guard in there at Macquarie. The board sees a long-serving lieutenant who knows that risk framework, who's comfortable with the sort of liquidity requirements of the bank because he used to be the CFO. Now he's run a big operating unit. He's overseen a big tech project and a big sort of investment program. Wrap him up in that Macquarie old guard magic, and they think they've got the right candidate. And, you know, they didn't even go outside and think about external candidates. You know, Glenn Stevens, the chairman, he said that in black and white, which is not something we hear every day.
No.
So they're really doubling down on that model. You know, if they wanted someone like a Greg Ward, then there's a few sort of Greg Ward type candidates in there, James. Like there's plenty of these sort of 20, 30, 40 year that are in these big positions globally, but they've stuck close to home and picked the guy who ran the retail banks. So good luck to them.
Anthony, how important do you reckon it is for the intern at Macquarie or the graduate recruit to see that it is possible to go from the bottom of the tree to the top of the tree at Macquarie? Not only possible, but that's the Macquarie way.
Well, Macquarie thinks that's incredibly important. And people that are in that system at Macquarie, you know, your 10, 20-year type people think that's incredibly important. So it doesn't really matter what I think, James. I mean, they think that's the model. You know, I hear that from people inside there. So it must be important, and they're backing it until it doesn't work anymore. You know, they do soak up these bright grads and everything from the top Australian universities. It's important if they want to invest in these people for 10 years, 15 years, that they keep them, right?
True.
They don't want to lose too many Mike Dorrells that go and start up Stone Peak and do wildly successfully on their own. If they can keep these people in-house, get them rising through the ranks, and if they can do that by showing this carrot of maybe getting to the CEO or moving into the big jobs,
sure.
That's a big part of it. So we have Greg Ward. He's coming in November. James, what do you think is at the top of his to-do list?
Yeah, it's an interesting one. I've been thinking a bit about this, Anthony, and the idea of a to-do list is probably not something that Macquarie would like to have Greg Ward focused on. The famous Macquarie management style is what's called loose-type management.
Yeah.
They let their people at ground level go off and come up with great ideas, find great profitable deals to do. That's the loose part. And then they very tightly sort of control the risk that they take and the way the deal's done and their approach to operating. So in some ways, the Macquarie way isn't to come in with a list of priorities and say, we'll do this, 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 and this, because those ideas come from the bottom up, or at least that's the logic. But I think there's a few things. I mean, it's only last September that Macquarie was mentioned in dispatches as having a look at buying a US private capital giant called Carlyle Group.
Yep.
And so that said to the market, hey, Macquarie's still looking for what the next growth chapter is. So I think that's the thing that people will be thinking about when it comes to Greg Ward. What's his big idea for growth? Is there a part of Macquarie that he'll emphasise, part that he might de-emphasise? I mean, maybe towards the top of his to-do list is who's going to replace him in the banking division. Like, that's an important decision. And then what is the ambition for the banking division? Is it just a homegrown business? Is there a certain level of market share that Macquarie's prepared to get to before, I don't know, the business becomes more complex to run? Is there a chance to take the banking division overseas and do what it's done here in other markets? Probably not, but that's an interesting discussion. Have I missed anything, Anthony?
No, I think that makes sense. So you've got like the key pillars, I'd say, is still infrastructure investing, commodities, and the Australian bank. Tinker them as needs and capitalise on that for shareholders. The big one for me, though, is culture.
Yeah.
James, I mean, he could be the last of the CEOs, or perhaps there's one more, who could have learnt at the feet of the giants of Macquarie, right? Your Tony Bergs and Alan Mosses and Nicholas Moores, Shamaras even. Yep. These business people, they're all getting on, right? Yep. Like a few of them are still in the building, but they're getting on. So that Macquarie culture and the fabric of the joint will change as the sort of new wave of leaders comes through. All of a sudden, you're getting people learning at the feet of the people who learn at the feet of Nicholas Moore. Are those people as good a teacher as, say, Nicholas Moore? Sure, they were going to respect and worship the past like they do and these great leaders that they think they had, but they're going to have to also celebrate the current day ones and hope they're as good as the former day ones. And if they're not, then they're going to have to think about this whole breed from within culture. That's Greg's sort of big challenge.
Yeah, it's well put, Anthony. Well put.
Okay, James, let's get to our second topic. And this week we got some seemingly good economic news on Thursday when the jobs numbers for June showed the economy created 76,300 jobs, far more than the increase of 15,000 jobs that was expected. May's jobs numbers were also bumped up for good measure. Now, James, that's pretty good news on the surface, but almost immediately we saw money markets increase the likelihood the RBA will raise rates in the coming months. So, James, are we in some sort of crazy world where good news is bad news for the Australian economy?
Yes, sadly we are. You always make the point, and I think it's really well made. It's never bad news that more people have got a job in Australia. We should always celebrate that. But the problem is that we've got this situation with sticky inflation where any sort of economic strength quickly flows through to make that inflation problem worse. And that brings the RBA off the sidelines. The consensus is there's one more rate hike to come this year. Mm-hmm. There's still a view that they might need a second one. I think that depends a little bit on what happens with the war in Iran, which has obviously heated up. US attacks have sent the oil price back over $100 US a barrel. That's not great for Michelle Bullock's worries about where energy price inflation's going. So, yeah, the RBA needs the economy to slow down. They've made no bones about that. And unfortunately, they need a little bit of weakness in the jobs market. It's just not coming through. Again, it's good news for Australian families who've got jobs, but it's not great news because your mortgage rate's probably going to go up in the next 6 months, and it might go up twice, which will really put some pressure on Australian households when they don't need it. So it's a really hard position to be in, but this is the result, Anthony. This is the result of what happens when we don't have productivity growth for a decade. We just don't have an economy that can support higher growth without an outbreak of inflation. I mean, Anthony, down here we've seen in Victoria strikes this week from teachers and nurses, obviously two of the hardest working groups of people in Australia. The teachers have been offered a pay deal of 28.3% over 4 years, which would make them the best paid teachers and support staff in the country. But they're after 35% over 4 years. And I think we're seeing a bit of this. We're seeing a bit more industrial unrest from the Pilbara to nurses to teachers. Is there any danger of that wage price spiral where prices and wages sort of chase each other higher, or are we still a fair way from that?
Yeah, I'm not begrudging anyone from getting a healthy pay rise, James.
Yeah.
If the boss offered me one today, I'd say, yes, please. Thank you very much. But, I mean, we just had a minimum wage increase, 4.75%,
Yep.
started on July 1. It was 3.5% the year before that, 3.75% the year before, 5.75% the year before that. Like you said, we have the teachers asking for 35% over 4 years in Victoria. That's 7.8% a year, James, over that 4 years, compounding. So I'm not saying the workers deserve it or not, but there's a cost to these pay rises.
Yeah.
And employers pay staff more if there's no productivity, as you've just outlaid, and there isn't at the moment. They'll seek to recover that pay increase from customers. Prices have to go up. In the case of teachers and nurses, I mean, we're talking about the government as the employer here.
Yep.
So government spending goes up. They have to increase taxes to meet that spending, or they have to borrow more and pay more interest. And I'm not sure either teachers or nurses are talking about increasing productivity about these wage increases, but that productivity piece is completely missing from the equation.
Yeah.
It'd be great to have a world where all the workers got 5%, 10% a year. I mean, I'd love it, James. I'm sure you would too, but the economy just can't handle it without the productivity growth. And we had former RBA Governor Philip Lowe, who's a productivity warrior, say that again this week. When we interviewed him about the ASX's new corporate governance principles, he really doubled down on that need to get business investing or putting more capital stock, as he calls it, in the economy. And capital stock's basically just creating productive assets. Problem is, though, business isn't in the mood to invest, while the economy can't grow up more than 2% without kicking off inflation because there's no productivity. So we are stuck in this
Cycle,
sort of world where we're going round and round and the productivity is missing. And yeah, absolutely, there's the ingredients there for a wage inflation spiral.
Yeah.
You know, that sucks.
Absolutely.
That sucks for living standards. It sucks for people who'd love, a few extra bob every week, which is all of us.
Yeah, indeed.
James, last weekend you wrote a long piece on the Australian economy, which really went off with readers. It argued there was a frustrating, perplexing, disappointing lack of outrage about the fact that real wages, that is inflation-adjusted wages, are going backwards and living standards are going backwards. I'm picking up a lot on this. Do you think this is resonating with the broader community?
I'm not sure. I mean, we've talked a lot, Anthony, about the idea that productivity is a hard concept to get your head around because it sounds like please work more and we'll pay you the same amount or less. Productivity's got an image problem, basically.
Yeah.
But we saw an interesting survey this week. I don't know if you picked it up from the RBA itself about economic literacy and what matters to punters out there. The biggest thing that matters to punters is inflation. I mean, probably didn't need a survey to tell you that, but I think it's valuable because I think people will start to connect the fact that inflation keeps going up and my interest rate keeps going up. Why is that? Why do I feel like I can't catch up? So I think that part will resonate with the broader community. Whether they can connect that to the need for reform, economic reform at a policy level, better infrastructure, more flexibility in the labour system. There's lots of ideas out there for productivity improvement. We just don't seem to be able to act on them. Whether we can get that connection going with the broader community, that's the tough bit. But what I am picking up, Anthony, from a lot of CEOs, they're frustrated about this. They're a bit angry about it. But I'm worried that I'm getting a bit of disillusionment with it. A lot of CEOs saying, who's going to change it? Labor's not interested. Coalition's in a mess. One Nation's, not really a serious political force.
Got bark and dog problems, mate.
got the problems with the dogs. So who's going to lead this debate? Now, maybe the argument is that business needs to lead it. But if you saw Anthony Albanese's speech at the Labor Party conference this week, and I know he's talking to the true believers, I get that, but it was very much us against them, workers versus bosses, very sort of polarising. I can feel the CEO's pain here. It's hard to see what the way out of this is. You hope it's not some sort of economic crisis that has to spark the change. That's what we don't want. Let's be proactive about this. And as you said, as you were talking about Macquarie, let's start creating some tailwinds rather than headwinds now so we can avert the next cost of living crisis. Back in the real world, Anthony, the here and now, what do you reckon Michelle Bullock's making of all this, the RBA governor? Jobs market strong, Iran's firing up again, oil prices back over $100 US. It's exactly what she didn't want, isn't it?
Hey, Michelle loves it when everyone has a job. She sort of tells us that every 6 weeks.
True.
It's just that it makes the job harder.
Yeah.
I mean, the jobs market's tight, and that's one of a handful of big factors adding pressure to inflation at the moment. I mean, that's very much of concern to her. If you accept the fact that productivity will be lower for longer, which you have to, and I mean, even the RBA has in its forecast and the way it's modelling the world, and you want inflation to get back to 2.5%, you need some more slack in the labour market, but we're just not getting it.
Yeah.
James, I mean, the next RBA board meeting, August 10 and 11, that could be really interesting.
Totally.
Futures market is saying 37% chance of an increase in rates again in August. I mean, that's about double what it was prior to that jobs number on Thursday. We get June quarter inflation next week. Economists are expecting a big number there, trimmed mean 3.8% on a year-on-year basis, 0.9% for the quarter, which is bang on the RBA's own forecast. I mean, if that number blows out, that meeting in August is going to be massive. So yeah, I'd say in one way it's exactly what she wants, but in the other way, the big jobs number is exactly what Australia doesn't need.
Yeah, well said, Anthony. As you said, there's inflation data next week. There's also some other key economic indicators we're going to get a look at. We'll come back after the break and talk you through those. Back in a sec. Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, as we said, inflation data for the June quarter, comes out on Wednesday. That's going to be an absolute barn burner in terms of where interest rates head next. But we've also got another big moment on Wednesday, the start of profit season. It's our favourite time of the year. It's like Christmas for the chooks. And we kick off with a biggie, Rio Tinto, one of the world's biggest miners. Anthony, all eyes on copper production here, I reckon.
Yeah, you're probably right, James. A bit of a warm-up, isn't it? Half-year numbers from Rio. I mean, it's already put its production reports out for the June quarter. So, I mean, the volume sort of equation's mostly accounted for. I'd love to sit around here and talk about the Pilbara, but I think you're right. I mean, copper is where the market's going to be focused on. That's where the sort of game's going for these major miners.
Absolutely. And then on Thursday morning, Anthony, we get the interest rate decision from the Federal Reserve. That's America's central bank. Mm-hmm. We're not expecting a change here, but obviously with oil adding to inflationary pressures, it'll be fascinating to see what the new chairman of the Fed, Kevin Warsh, has to say about inflation. I still think he'd like to cut rates if he could, but he's talking a tough game on inflation, which is good to see. Anthony, speaking of inflation and inflationary pressures, old Donald Trump's come out and he's fiddling around with tariffs again. Now, his previous tariff regime sort of falls over, and so he has to come up with a new tariff regime. Australia's going to be hit with a 12.5% tariff as part of 60 countries getting whacked with various levels of tariffs. Now, Anthony, the reason given here is that Australia hasn't been tough enough on forced labour. That's the sort of excuse/rationale. I mean, seriously, that can't be right, can it?
Yeah, I'm really fascinated with this tariffs one, James, just to see how our bosses sort of treat it.
Yeah.
Like, imagine a few years ago, 12.5% tariffs on Australia. Like, it would be massive news, right? Front page of the paper, all that sort of stuff. I'm interested to see whether, this really does get blown up into big news or if it's just like shrug your shoulders, get on with it.
It's funny how things get normalised, isn't it?
Yeah,
absolutely.
Totally.
Now 12.5%. Oh, yeah, we can cop that. Whatever.
Yeah.
Move on.
Yeah.
All right, Anthony. We love questions here on the Chanticleer podcast. This week, our questions from Arthur in Melbourne. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can send us a question via the widget on all Chanticleer articles at afr.com. And you can send us an audio question. Just record a voice memo on your phone and send it through to us with your name and where you're from. And that's exactly what Arthur's done.
G'day, Chooks. Arthur from Melbourne. Love the pod. Palantir boss Alex Karp went on CNBC ripping into skyrocketing token bills and pushing for data sovereignty. Companies owning their models and their data instead of renting it from OpenAI or Anthropic. Meanwhile, open models like China's GLM 5.2 are benchmarking near frontier at a fraction of the cost, and MIT reckons the gains from scaling are fading. So, is this the wedge that cracks the AI trade? If the big corporates decide a self-hosted open model covers 90% of what they need, The frontier labs lose their best customers just as the moat is shrinking. And here's the kicker. The whole data center boom is priced off endless demand for frontier compute. But Meta, as you covered, is already selling its excess capacity. And as you saw, the near cloud stocks tanked on the news. If the future is smaller, cheaper, self-hosted models, who's filling in all those additional gigawatts? No wonder the labs are racing each other to an IPO. Keen to hear your thoughts.
This is a really interesting question, Anthony, particularly in the wake of that Kimi K3 news this week, isn't it?
Oh, sure is right up your alley, James Thomson. Absolutely. It's one of the wedges. Huge CapEx super cycle on there at the moment. $1 trillion a year investment. You know, investors need to believe it can be recouped by earnings in coming years. Anything that questions those future earnings is worth considering. Could come a day when the market flips on this, like big time. And then the whole sort of AI narrative gets turned on its head. That day hasn't come yet, despite, you know, Kimi K3, like we were talking about earlier. But, I mean, this is a red hot issue.
Yeah, Arthur's right about the IPOs of Anthropic and OpenAI. Like, Anthony, I think even, 4 weeks ago, we probably thought they were a sure thing. And since then, we've had SpaceX float, soar, and then plunge back to Earth. Well, not quite plunge back to Earth, but it's underwater. It's well below its issue price. We've now got this Kimi K3 threat. Do you reckon OpenAI and Anthropic could get sort of the $1 trillion IPOs they were hoping to do? Would they get away in this current environment?
Certainly much tougher than it would have been, James. And IPOs are all about timing. You know, you just got to really tap into that market sentiment. Then it's there. I mean, we see in Australia all the time smaller floats than Anthropic and OpenAI, obviously. But businesses, they start thinking about an IPO when the time's good. And by the time they're actually ready to go, by the time they've got investors ready, mate, they completely missed the window.
Yeah.
Right? Canva's sort of one of those you could argue it's happened to them. And that's no small one. So, yeah, absolutely, James. I mean, they're going to have to time them to absolute perfection to get those fat valuations.
Yeah, the one thing I'd say is, look, the hyperscalers, the companies like Microsoft, Meta Platforms, Amazon and Alphabet, they're still spending. We saw Alphabet's quarterly results this week. They've jacked up their capital expenditure plans for this year. They're now expecting to spend up to US $205 billion in 1 year on data center infrastructure.
Wow.
That is a phenomenal amount of money. This train is not slowing down yet. So, I mean, let's see how all that goes down over the course of the June reporting season in the US. But just the size of the numbers is incredible still, and I think that's going to be the story for the rest of the year, one way or the other. So, great question, Arthur. Thanks for sending it in. All right, Anthony, thanks for your help again today on the podcast. Fascinating week. And yeah, next week looms large with Rio Tinto, inflation, and lots more news on Iran and AI, I reckon. It's going to be a big one.
Yeah, we'll be barking up trees all next week, James.
I love it, Anthony. Thanks for joining us. We'll see you next week. If you like the podcast, share it with a friend or give it a review, as it helps other listeners find us. And if you follow us, you'll never miss an episode. At the Financial Review, we investigate the big stories about markets, business and power. You can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald. It was produced by Mandy Coolin. Our theme is by Alex Gow, and the head of premium content is Fiona Buffini.
The Australian Financial Review.